Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into Next Level Charting. Thank you very much for joining us. So today we're going to see how 2020 is channeling 2016 on the charts. We've got big bullish continuation patterns. We've got small caps and junk bonds still doing good. And we're going to look at healthcare. So at TrendInvestorPro.com over the weekend, I put out a video and I was comparing the S&P 500 chart or SPY with the 2016 period, September, October, early November, with the current period. And believe it or not, there are a lot of similarities and they are bullish. So I was scrolling down here on this chart. There is SPY just before the election. And you can see we have a new high there in early September, and then we declined into late October, kind of like an A, B, C correction. And then we got this big surge that we'll see. But before we get to that, I did notice that the financial stress index from the St. Louis Fed has been below zero for the most part since early July. There was one little tick there above zero. And when it's below zero, that means there's below average stress in the financial markets. And the Fed puts 18 indicators together. And that's basically bullish for stocks when there's no signs or below average signs of financial stress. So that supports the bull run. And then we were looking at RSP, the equal weight S&P 500 ETF. And we did have a failure at resistance and a breakaway gap, but bigger picture was an ascending triangle, which is a bullish continuation pattern. And we're also seeing that in the HYG, the junk bond ETF. So now let's get to what happened in 2016. So here we had the big plunge with Brexit, but then we rallied back up to new highs. And here we go, September, we start to move down. And we didn't really have a clear ABC decline, but we clearly moved down from early September to early November. And then there's the Monday before the election. That's that breakaway gap. There's the Tuesday, election day, continued higher. And then the Wednesday, you can see there was a weak open and a strong close. But if you look at the overall pattern here, what's going on, you have a move to new highs. You have a correction that retraces 1/2 to 2/3, normal correction. You have a falling channel, which is normal, and you have a breakout. And that breakout signals a continuation higher. Now let's look at the current chart for SPY. So here we are on StockCharts, and I've got the 2016-17 chart there. And there you can see the continuation higher after the breakout. And in the right-hand corner there, you can see the current chart, the new high. And I'll go ahead and move down and focus on that one, put it in the main part of the window. But we hit a new high. We had this correction. We didn't get a lower low. It wasn't a falling channel like we had in 2016, but it was a correction within a bigger uptrend. And you can see retrace 1/3, 1/2 to 1/3, 1/2 to 2/3, of this prior move up from June. So it's a normal correction. You need to digest gains. And so we did that for about 10 weeks. And then we got this 3-day surge. So Monday and Tuesday before the election, we started moving higher. There's the Wednesday. We don't have the follow-through breakout yet, but this is still a bullish configuration because you're above the 200-day. You hit a 52-week high in early September. That means the long-term trend is up. A rest or consolidation is typically a bullish continuation pattern, and so I would expect an upside resolution here. Now here's QQQ, and it was lagging a little bit maybe, but it's still got a bullish continuation pattern, a big surge to new highs. You're overextended. Of course, you're overextended here, you're overextended here, you're overextended here. But now we've digested these gains. We've surged, we've rested with a consolidation, And one of my favorite setups when you've got a consolidation is to play the bounce off the consolidation low. So you get this first decline, then you get a bounce, and then you get the second decline that tests this low. And when you're testing that low, and RSI's in that 40 to 50 zone, that's a potential setup for a mean reversion bounce. And sure enough, we got it. And of course, the first bounce wasn't very big on Monday. Tuesday had a bigger move higher, and then we have a gap up on Wednesday. So as long as that gap holds, that's clearly bullish. If you give it back and you move below that close on Monday, then you have to reevaluate. But right now, we have a mild oversold condition with RSI down there, a successful bounce off support, and that is bullish until proven otherwise. Now, if we look at small caps, we can see small caps are still doing just fine. We've got this rising channel here with a higher high, higher high, higher high, and then we've got higher lows coming in. So that's an uptrend. And then we had this pullback, had a gap down, but then firmed and a gap up. And so you take that together, and that's basically an island reversal within this rising channel. And again, here you can see RSI in that 40 to 50 zone. So IWM still looks okay. I don't think it looks as good as QQQ. It did get a higher high. So QQQ did not get a higher high at this stage. But QQQ did hit a 52-week high. And you can see IWM has yet to hit a 52-week high. But, given the uptrend and given the broad market environment, which is bullish, I would expect a higher high and a 52-week high coming in the weeks, months ahead for IWM. Now, I mentioned that the junk bond ETF had that bullish ascending triangle working, and here it is. So, yeah, I'm taking a little bit of liberty with the lines here, but, we can see some resistance, overhead supply coming in 3 places in that 85 area. And then we have our first low, a higher low, and that higher low there means that demand is coming in at higher levels. And then we got another higher low as demand came in above this low. So we've got a rising demand line, we've got a flat supply line, and we're poised to break above it. And we break above it, that would signal a continuation higher and argue for a move to new highs. And so this chart is kind of reflective of what's happening in IJR, the small cap S&P 600 ETF, as well as the equal weight S&P 500 RSP, because the banks are still dominant in there, the industrials are still dominant in there, whereas, SPY, you've got tech still carrying a big weight, like 27+% of the index. But overall, I'm still bullish on small caps because we've got the rising channel in IWM, bullish on the market, and bullish on junk bonds because it looks like they're poised for a breakout here. Now, of course, the big move yesterday, Wednesday, was in healthcare. Everything healthcare related surged. Here's the healthcare SPDR XLV hitting a new high with a breakout. And so you can see it was kind of a laggard, because it had this big surge and then it just kind of worked its way higher. And it was back near the 200-day in September and October. So, it didn't get that big lift and get well above the 200-day. But come on, an advance is an advance. We still have higher highs and higher lows. We basically consolidated here, and then look at that liftoff. And it started on Monday and Tuesday. And that's because the market is a forward-looking beast. And yes, it is a beast of a market. Make no buts about it. So market is going to anticipate. And that's why it's called a risky market. You need to be taking risk in order to profit and lose, of course. But we can see this big surge Monday and Tuesday because the market saw something. The market was already pricing in what it thought would happen on Wednesday. And then Wednesday, of course, it did further pricing in with a breakout. So this basically signals a continuation of an already existing uptrend for XLV. Now, there's an interesting story happening within biotechs in that we have smaller cap biotechs leading the large cap biotechs. And how do I know that? Well, if you go to etfdatabase.com, which I will do right now, and you look at IBB, I'm going to go ahead and do IBB, and we're going to look at the holdings in IBB. And over on the left, we see the holdings. And you can see it's dominated by large caps. Gilead, Amgen, Regeneron, Vertex, all coming in at 6 to 7.5%. Illumina, Biogen, Seagen, Moderna, Alexion, Insight. So it's heavily weighted into these top names. Whereas you look at the XBI, it's a much broader biotech ETF, and it captures basically what's happening with the average biotech. So I click holdings here and look at that difference. All right, do you know any of these companies? Maybe you do, but you can see that it's a completely different list and they're more equally weighted. None of them amount to more than 2% of the ETF. So if you want an idea of what's happening for biotechs as a whole, look at XBI. If you want to get that large cap focus, look at IBB. So going back to IBB, we can see that, you got the big surge. It was leading up until mid-July, and then it had a pullback, and we got a breakout here. And that was bullish, but that breakout didn't hold. You can see this kind of breakout zone, and you fell all the way back below it. And that was kind of a negative. But overall, it looks like a big advance and a big correction. And now we've got this big gap and surge. So it looks like we're poised in that correction and move higher. Now, one thing that shows weakness in IBB is this is the Stoke close indicator, 125.5. So it shows you the 6-month range, basically, where the closing price is relative to the last 125-day range of closing prices. And it moved below 40. And that's a sign of weakness if you have to dip all the way back down below 40 in the Stoke close. And if you compare that, which you can compare those numbers. If you look at XBI and you go down to that Stoke close indicator, this is the fast stochastic, by the way, 125.5 with D at 1. You can see it did not go below 60. And it probably didn't, maybe it went below 70, but just barely. It held up a lot better. And then you look at the price chart, it also held up a lot better. Big surge, whoops, let me change to my line. And then you had a normal pullback, a breakout, a throwback that pretty much held, and that's a new high. And so after we get that new high, we get a little falling wedge. That is a bullish continuation pattern. We had the breakout on Monday, the surge on breakout on Tuesday, surge on Wednesday, and that's a new high. So just by the fact that XBI is already at a new high shows you that it's outperforming. And then look at RSI in that 40 to 50 zone again as we get that pullback. So that's the heads up that we might get a bounce, and there we got the breakout. All right, so that concludes this edition of Next Level Charting. Check out trendinvestorpro.com if you'd like to know more about our services. Thank you very much for tuning in, and have a great week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.